time to get into the latest developments from a markets perspective and also have a look at the week that was. And we're joined by Patrice Rousseau, who is from Ashburton Investments. Patrice, thank you so much for your time. A very interesting markets picture when you look at what's happening from the Asian perspective and also European markets making that two-day break. And I guess, I suppose, the sentiment has just been the Federal Reserve minutes weighing on market sentiment. Is what we're seeing in Europe filtering through to our local markets right now?
Yes, well, definitely so, Nastasia, and good afternoon to you and your viewers. We're breaking a three-day stance where markets have been on the down and the JSE is up 70 basis points. The all share, about three-quarters of the all shares up. So quite a good start and looking stronger as we go into the afternoon due to US futures, as you mentioned already, being positive. So definitely a good start to the day and a reversal of the last few days where really the minutes from the Fed are really, and its hawkish stance, which talks about them shrinking their balance sheet, weighing on sentiment globally.
So let's talk about those FOMC minutes, because the one thing, or rather the one call that's going louder is the call of a recession. And the argument is that the Federal Reserve is going to be forced to push the U.S. economy into a recession to at least get a handle on inflation. What is the impact of, I suppose, rising interest rates, the possibility of a recession on emerging markets?
That's a very good question. As the Federal Reserve or the Americans raise interest rates, what you tend to find is money flows out from the rest of the world and moves back into the American or developed markets. That tends to mean that the cost of funding or the cost of liquidity in the rest of the world has to go up to compete or to retain these funds. And then you find the cost of credit also starts to rise. So what that would mean for a market like ours would mean that we would have to follow suit. Interest rate would have to continue rising. Luckily, the Reserve Bank in South Africa has been ahead of the curve, slowly increasing interest rates. But the rand, even the rand, which has been quite strong, if money flows out of emerging markets and out of South Africa, it's likely that the rand might weaken. And the situation is that it makes countries which have got deficits like ourselves more vulnerable because we need to fund our budget deficit on an annual basis. So the difficulty we have is if we don't raise our interest rates is we will not have foreign investors willing to put money and buy our government bonds. So that leads to a situation that emerging market as a whole, and South Africa as part of the emerging markets, need to follow suit and be almost ahead of the curve to be able to retain that liquidity flow that might go back to the U.S.
Well, the one thing that has been, I suppose, a dominant news feature has been what's happening with FlySafair, which got me thinking about JSE-listed leisure stocks and their performance since last year till now. What are you seeing when it comes to recovery of those particular stocks?
Yeah, Nastasia, very good question. The travel and leisure hospitality industry, if you recall, 2 years ago into the COVID lockdown dropped almost 70% if we go back to March 2020. Since then, since these lows, they've increased almost threefold. And if you look at specific stocks, for instance, Sun International has increased over 100% over the last year. Sogo, another example of a hospitality hotel group, has increased 71%. So really, there's a lot of tailwinds behind these stocks. You have a return to normality as lockdowns are behind us. You have the president who has put the state of emergency behind us. So it's a combination of leisure travel increasing, business travel increasing, and also these companies, if you take, for instance, Sun International, a big portion of its revenues is derived from gambling. As casinos open up, there's also a push for footfall to go back to normal and increase in revenues there. So a lot of tailwinds behind them. They're still trading below where they were pre the COVID lockdown 2 years ago. So it's a return to normal, really, that we're seeing. And we're also seeing that in their results. Like after posting quite heavy losses a year or so ago and cutting costs, they're now back into profitability.
Which is a nice segue into my next question around what's happening in the Asian region, in particular Shanghai, when we look at those extended losses and the possible, I suppose, call it repercussions it could have on supply chains, etc. What do you make of the market sentiment around Asia right now?
Yeah, it's quite interesting and good question. So the sub-Asian continent, we've seen a lot of market doing very well of late because they're commodity exporters, the likes of Indonesia, even Thailand and the like. China it's an odd story. It's the biggest emerging market in most indices, but it's really been weighed down, as you said, by regulation one, and now this really spike in COVID cases. So the combination of regulation on the internet companies and the spike in COVID cases has put a lot of pressure on the Chinese market and has led to really money moving away from China into other markets, including South Africa. So the big question is China going to be able to contain the next wave of COVID? That's the one thing. There's question marks about the effectiveness of the Chinese vaccine, which they themselves manufacture, which don't seem to be as effective as other brands.
All right, Patrice, thank you so much for making time to chat with us.